Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Simon Brazier, manager of the Investec UK Alpha Fund, to give his 3 stock picks. Hi Simon.
Hi there, Emma.
So what's the first company you'd like to highlight today?
Well, the first company is one of my very long-term holdings, which is Booker. Our main theme of our portfolios in a low-growth world is trying to find companies that can reinvest their cash flow for growth. And Booker, to me, is a classic example of this. I mean, here's a company in the food retailing, food distribution area. Everyone talks about Tesco's and what a disaster it's been and how there's pressure on the food retailers, but this is a company that's continued to grow in that environment because actually they've built out a fantastic online distribution platform that can deliver frozen, chilled and fresh food across the UK, but not serving the consumer, but serving private, independent retail stores, cinemas, prisons, hospitals, etc. And a classic example was last year he bought the Budgens and Londis stores across the UK. They were loss-making, but Booker are able to deliver those to those stores profitably, and we're going to see very good returns on the investment. He actually spent £40 million buying that business, and with the recent sales of some of the freeholds that he bought, he's already nearly got his £40 million back. That's Charles Wilson, the chief exec. So a very good story, good growth potential with that business. Most importantly, he's able to use his cash flow to find opportunities like the Budgens and Londis stores to reinvest for growth.
I mean, it sounds like a golden child there. You've held it for a very long time. What risks are involved in that stock? Is it very linked to the domestic economy?
Yes, it is. I mean, the reality is that if we would, some of the threats may be that, that Booker is making the independent retailer quite profitable. The supply chain for Booker is such that they are buying more Pepsi Cola than any of the other big supermarkets, so they are able to make their customers, who are the convenience stores, quite profitable. So if we were to see the big supermarkets getting their game back together, that may be a threat. But the reality is it's such an incredibly well-run business now, and with some of their competitors more stressed financially, some of them have quite a lot of debt, I think it's a company that can continue to grow in what is a low margin, relatively low growth business, but actually if you're taking market share, it can be profitable from a cash point of view.
And what's the second stock today?
Well, again, in a low growth world where we're not relying on the top line growth of companies, I actually want to find companies that have got some self-help, where there's recovery opportunity. And Balfour Beatty is a company that I invested in the middle of last year. Leo Quinn, who was the new chief exec, he was at De La Rue and Kinetic before, has come in, and look, Balfour Beatty is never going to be the highest quality business. It's a contracting business. It has very, very low margins. But one dynamic of Balfour Beatty that has been weak has been its cash generation. And they are doing 2 things. They're improving the contracts they write so they can improve their cash from that, and also improving their cash within their business, their working capital, how they run their business. And we're starting to see that cash generation come through in the business already. And yes, profitability may take a bit longer, but for me, if Leo Quinn can continue to deliver cash flow and grow cash flow, we only need to see the margins in their contracting business back to 2-3%, and the shares could have significant upside.
And what's the third and final stock?
Well, the final area that may seem slightly strange in all the uncertainty around Brexit, but actually we see the UK economy as being a bit of a star in the global economic system. In the developed world, we have 2% plus GDP growth. Consumer confidence is relatively strong, and low interest rates, low unemployment, etc. And this gives rise to the fact that some of the domestic stocks we look at could do quite well, and one which is Lloyds Bank. I'm not a stale bear on Lloyds. I've only bought Lloyds recently in the last year. I particularly added my weightings after the election, and the 3 key factors for me are: first, the political and regulatory environment around the banking system is better. The government, the FCA, the PRA, who've just signed off their dividend, are much more supportive. Secondly, the regulatory, but from a capital perspective, is better. Lloyds now has a 13% core tier 1 ratio. It is at where it needs to be, which means, therefore, as it grows its business, which will be much slower than it was historically, but it can generate capital, it can generate cash, and that cash flow does not need to go back into the balance sheet. There was always this tension before. Vince Cable saying, I want the banks to lend, and George Osborne said, I want them to get your book in order. Yeah. Today, Vince Cable should be happy because actually they are able to lend, and George Osborne should be happy because their balance sheet's in a good position, and hence they can generate cash, which should come back to me as a shareholder. And the special dividend we've just seen is, I think, a good sign that can continue from here.
Simon, thank you very much.
Thanks, Emma.
This is Emma Wall from Morningstar. Thank you for watching.